Take a good look at this chart. This is the S&P 500 over the last 24 months. It's a masterpiece. Inflation is cooling, the Federal Reserve is cutting rates, and the soft landing narrative is everywhere. You can feel the relief in the air. The bear market is dead. The bull is back. Everyone is convinced that the danger is over. But here is the problem. This isn't a chart of 2025. This is a chart of 1937. We forget this part of history. We think about the Great Depression as one long, flat line of misery. It wasn't. By 1936, the U.S. economy was booming. Stocks had rallied 400% from the lows. People were driving new cars, buying radios, and celebrating the new era. And then, in the spring of 1937, the trap snapped shut. In just 12 months, the market collapsed by 50%. Industrial production fell by 30%. Unemployment shot back up to 19%. This is known as the double dip. And historically, the second crash is always more painful than the first because it wipes out the people who thought they were safe. If you overlay the economic data of 1937 on top of 2025, the correlation isn't just similar, it is terrifying. Today, I'm going to show you the 3 deadly parallels that suggest we are walking right into the 1937 trap. We'll look at the specific mistake the Fed is making right now. And most importantly, I'll give you the survival portfolio, the exact assets that held their value while the rest of the world burned. Chapter 1. The Miracle Tech Trap. RCA versus Nvidia. The first parallel is the most obvious one, the new technology bubble. In 2025, the narrative driving the market is artificial intelligence. We are told that AI changes everything, that productivity will skyrocket, and that valuations don't matter because this technology is a revolution. In 1937, they said the exact same thing. But it wasn't AI. It was radio. Radio was the internet of the 1930s. It connected the world instantly. And the poster child of this boom was RCA, Radio Corporation of America. Investors poured their life savings into RCA. They said, "Every home needs a radio." This company cannot fail. And they were right about the technology. Radio did change the world, but they were wrong about the stock. When the liquidity dried up in 1937, RCA stock crashed. It didn't matter that the tech was real. What mattered was that the price was priced for perfection in an imperfect world. Today, we see the exact same concentration. The entire S&P 500 is being held up by 5 or 6 massive tech companies. If you remove the Magnificent Seven from the index, the rest of the stock market has barely moved. This is the definition of a fragile market. Chapter 2. The Wage Price Spiral. Unions strike back. Here is a parallel nobody is talking about. Labor power. In 1936 and 1937, the U.S. saw the biggest explosion of union activity in its history. The CIO launched massive strikes in the steel and auto industries. The government supported this. They believed that raising wages would increase purchasing power and help the economy. But as Murray Rothbard documented in his book America's Great Depression, this artificial wage hike became the prime generator of unemployment. Because wages are a cost to businesses. When you force wages up by 30% or 40% without a matching increase in productivity, you squeeze corporate profit margins. In 1937, businesses were squeezed. They couldn't pass the costs on to consumers because the economy was fragile. So, when the downturn started, they had only one choice: mass layoffs. Look at today. We are seeing historic wage increases for dock workers, auto workers, and airline pilots. We call it sticky inflation. The Fed thinks inflation is gone. But when wages go up, inflation refuses to die. This forces the Federal Reserve to keep interest rates higher for longer, which leads us to the trigger. Quick pause. If you don't want your portfolio to flatline like the market in 1937, you need the 2-step survival kit. First, resuscitate that like button to wake up the algorithm. Second, hit subscribe to inoculate yourself against the next crash. Don't miss the warnings. Chapter 3. The Fed's Fatal Mistake. Sterilization. Parallels don't cause crashes. Policy mistakes cause crashes. And in 1937, the Federal Reserve committed murder. We know exactly how they did it, thanks to the data in Milton Friedman's A Monetary History of the United States. It wasn't just about raising rates. It was about two specific technical disasters that drained the lifeblood out of the economy. Mistake number 1, the reserve requirement trap. In 1936, banks were holding a lot of cash. The Fed looked at this and said, "Look at all that excess cash. That's dangerous. It could cause inflation." So in 3 distinct steps, August 1936, March 1937, and May 1937, they doubled the amount of cash banks were required to hold in the vault. Friedman and Schwartz proved why this was fatal. The banks weren't holding that cash because they were greedy. They were holding it because they were scared of another panic. When the Fed locked up that cash, the banks panicked. They stopped lending immediately to rebuild their safety buffers. The money supply didn't just slow down, it contracted. Mistake number 2, gold sterilization. This is the smoking gun. In December 1936, the U.S. Treasury began a policy called gold sterilization. Normally, when gold flows into the U.S., it expands the money supply. But the Treasury was terrified of hot money causing inflation. So they started selling bonds to buy the incoming gold. And then they locked the gold away in an inactive account. This completely severed the link between gold and money. High-powered money stopped growing. The liquidity tap was turned off. Fast forward to 2026. The Fed is currently doing quantitative tightening, QT. Every month, they are letting $60 billion roll off their balance sheet. They are actively pulling liquidity out of the system just like they did in 1937. They are draining excess liquidity from a banking system that is secretly terrified of commercial real estate bad debts. They are making the exact same mistake. Chapter 4. The War on Business. The Fiscal Attack. There was one more nail in the coffin of 1937. The Undistributed Profits Tax. In 1936, the government passed a new tax on corporate savings. They told companies, if you keep your profits to reinvest in your business, we will penalize you. You must pay them out as dividends. They thought this would force money into the economy. Instead, it stripped companies of their safety nets. Businesses couldn't save cash for a rainy day. So, when the banking crash hit in 1937, corporations had no cash reserves. They went bankrupt instantly. Capital spending collapsed because nobody had the money to build new factories. Does this sound familiar? Look at the proposals for 2025 and 2026. Tax on unrealized gains. Higher corporate taxes. It is the same philosophy. Punish the savers. And the result will be the same. When the liquidity dries up, the businesses will have no cushion to break the fall. Chapter 5. The Survival Portfolio. What held up? So, if history repeats and we get a 50% drawdown in the S&P 500, does everyone go to zero? No. In 1937, there was a specific group of assets that survived the storm. Here is my 1937 survival portfolio, adapted for the modern market. Asset number 1, the rent collectors, high yield, low beta. In a crash, growth is dead. Nobody cares about a tech company's earnings in 2030 if the world is burning today. Investors flock to cash flow. In 1937, utility stocks and companies with hard assets outperformed the broader market. For 2026, this means A. Energy pipelines. They get paid a toll just to move oil/gas. B. Consumer staples. People still buy toothpaste and toilet paper in a depression. C. Utilities. You have to keep the lights on. These stocks pay you 4 to 5% dividends while you wait. That dividend becomes your lifeline when capital gains disappear. Asset number 2, the fear hedge, gold. In 1937, there was a flight to safety. But remember, in 1937, gold was fixed at $35 an ounce. Today, it floats. In a credit collapse, where banks stop lending and companies go bankrupt, gold is the only asset that is not someone else's liability. Allocating 5 to 10% is your insurance policy. Asset number 3. Dry powder, short-term treasuries. In a deflationary crash, like 1937, cash is king. When the market fell 50% in 1937, the man with cash became the master of the world. He could buy General Electric and GM for pennies on the dollar, keep a war chest in short-term T-bills. They are liquid. When the crash happens and everyone else is panic selling, you take this dry powder and you go shopping. Conclusion: the delusion of management. Why do we keep making these mistakes? I want to leave you with a quote from a book actually published during the crash in 1937 by Phillips, McManus, and Nelson. They were watching the disaster unfold in real time, and they wrote this warning. The Depression was the price paid for the experimentation with managed currency. The policy of price stabilization tends toward its own collapse. They meant that when you try to artificially smooth out the economy, when you try to manage the currency to get a soft landing, you don't eliminate the risk, you just delay it. And when it finally breaks, it breaks twice as hard. They tried to engineer a soft landing in 1937. They failed. History is screaming at us. Are we listening? In the next video, we are going to look at the other scenario. What happens if the Fed panics and turns the money printer back on? Subscribe so you don't miss it.